You think banks lend out money that already exists. They don't. Every time a bank approves a loan, brand new money is created. Not printed, not transferred, created. Quietly, legally, with a few keystrokes. And almost no one notices. Because if people really understood this, the entire idea of money would feel unstable. Let's start with a simple moment. You walk into a bank. You ask for a loan, a mortgage, a car loan, a business loan. The bank doesn't go into a vault. It doesn't check how much cash it has. Instead, it opens a computer and types a number into your account. That number did not exist 5 seconds ago. Now it does. This matters right now because debt is everywhere. Interest rates are high. Banks are more powerful than most governments. And the way money is created explains why prices rise, why asset owners get richer, and why saving feels like running in place. So how does it actually work? Let's strip it down.
When you deposit money in a bank, you think you're storing it. You're not. Legally, that money becomes the bank's money. They owe you a promise, not the cash itself. Now here's the key part. Banks are allowed to lend most of that money out, not all of it, just enough to keep the system stable. This is called fractional reserve banking. But that name makes it sound technical and boring. The reality is much simpler. If a bank has $1, it can lend out many dollars. How many? It depends on regulations, risk rules, and confidence. But historically, $1 can support 10 or more dollars of loans. That means $9 are created out of thin air. Here's the uncomfortable part. When the bank gives you a loan, it doesn't give you someone else's savings. It creates a deposit in your account. That deposit is new money. You can spend it, transfer it, buy a house with it. The money feels real because it is real to you. But it didn't come from the past. It came from the loan itself. Debt comes first. Money comes second. That's the inversion most people never hear about.
And it gets stranger. When you pay back the loan, the money disappears. Not moves, not recycled, deleted. The principal vanishes. Only the interest survives. Which means the system constantly needs new loans just to keep the money supply from shrinking. That's why economies are addicted to growth. No new debt means less money. Less money means defaults. Defaults mean panic. So the system keeps lending. Now here's the irony. Banks tell us they're intermediaries, middlemen, just matching savers with borrowers. But in reality, banks are manufacturers. They manufacture money. Central banks don't create most money. Commercial banks do. Central banks just set the conditions, interest rates, rules, emergency backstops. The real creation happens quietly, loan by loan. This is why asset prices rise faster than wages. New money doesn't enter the economy evenly. It enters through loans, mortgages, corporate debt, financial markets. The first people to touch new money are banks, investors, and asset owners. By the time it reaches everyone else, prices have already adjusted. Same money, less purchasing power. That's not a conspiracy, it's mechanics. And it explains why inflation feels invisible at first. Nothing looks wrong, accounts are full, markets are up, credit is flowing. Until suddenly, everything costs more. Now zoom out. If money is created by debt, then stability depends on confidence. Confidence that loans will be repaid, confidence that banks won't fail, confidence that everyone won't ask for their money at once. Because if they do, the money isn't there. That's why banks need bailouts. That's why governments step in. That's why the phrase "too big to fail" exists. Not because banks are special, but because the money system is fragile. And here's the quiet question no one likes to ask. If money only exists when someone owes something, what happens when people can't afford more debt? And if banks stop lending, does money stop being created? That question doesn't have a comfortable answer. And that's why most people are never taught how money is actually made.